Hey everyone, Brian Bogner, Greg Towner here for a special edition of our 20-minute market breakdown. We are going to be discussing today the 10 things that you need to be focused on right now as we're dealing with this tariff volatility that the markets are going through. Now, we are recording this. It is Wednesday, 2 o'clock Eastern Time, and the Trump administration just announced they're going to be pausing a bunch of the tariffs, and the market is ripping and roaring higher. So, we could record this tomorrow and it could be the complete opposite. We don't know, but that's just the times we live in right now. But we wanted to bring you the 10 things that you as an investor need to be focused on. And we are going to be referencing some charts, which we normally don't do in this type of episode, but we are today. So if you can watch this on YouTube, that would be great. If not, we'll try to talk through it, so you'll be good to go there. But let's go ahead and get started. Number one, Greg, the negatives are clearly obvious, right? Like
Right.
there's tons of negativity in the news. It's a feedback loop. It's just going on and on and on. We don't have to go far to get the negatives, right? But look, the U.S. economy, we do have a great track record of overcoming some of these huge shock events, right? The Great Financial Crisis, the 9/11, the COVID stuff. Like
Yeah.
there's usually some positives here. What are some positives we need to be thinking about right now?
Yeah, you're right. A long-term track record of getting past lots of different types of events. And I think right now, as scary as it seems, both companies and individuals are, on average, well positioned for whatever shock might come. We've been talking for a while about how US companies, especially the larger ones,
Hmm.
have really healthy, clean balance sheets. A lot of them took out debt a few years ago at basically 0%. So they have
Right.
clean balance sheets. And obviously, there's plenty of Americans that aren't doing great, but there's on average, American balance sheets, if you want to call it that, are much healthier now than before the great financial crisis.
Right. Okay. Um, when you have a lot of volatility, right? Typically fear, which is an emotion, runs high. Um, I know you've written a ton about emotional decisions, especially in investments, never work out in the long run. Talk to us about that.
Yeah, I mean, back in 2018, we wrote a white paper called The Greatest Obstacle to Investing. And this chart we pulled from that paper, and we can get you that paper if anybody wants it. But we created this chart called the emotional investor to display some of the typical behavior and thoughts that goes through investors' mind over time. So what you're seeing is a line chart of the S&P 500 from about 2004 up until around the time we created this, we call it 2018. And just goes through a lot of the emotions. So on the far left, it was remember this was when everybody was coming out of flipping houses and everything, and they were no longer in stocks. And then the stock market started to go up. And that's all they wanted to do was buy stocks. And at the top of the market, people were looking at their account two, three times a day, marveling at it. And then, of course, when the financial crisis hit, they everything rolled over. They were really scared. They said, "Oh, just let me rally back to where I was, and I'll sell." Or then they went down further. They said, "Let me double down." And then they couldn't sleep. And then they couldn't look at their statements anymore, and they just gave up. Right, sold everything. Get me out of here. Well, that's a bad enough mistake. But then what happens after that, oftentimes, is you just can't allow yourself to get back in.
Right.
There's any number of excuses. Oh, this is a bad economy, or it's a Fed-driven economy, or I don't like this president, or whatever the case may be. And Brian, I know the financial crisis is over 15 years ago now. It was just last year we spoke to a prospective client who still was in all cash because they sold during the financial crisis.
Right.
So it's still people that are trouble getting past this. So this is why everybody should focus right now, but always be very careful with making emotional decisions.
Okay. Amen to that. Um, okay, so we've got there are some positives. We cannot make emotional decisions, but there's also a lot of uncertainty right now, right? So
Right.
I think we do need to come to a place where we recognize that we don't really know how this is all going to work out, right? And there's a lot of predicting coming out, right? Well, if this tariff happens, or if this happens, and this is going to happen, and the market's going to do this and this and that, like there's been a slew of articles and things that I've seen that the market's going to go, zigzag or left, up, down, left, and right. Let's talk about that.
Yeah, I mean, I have seen some of the greatest minds with great records in our industry right now saying, I have no idea how this is going to play out. And that's the reality. I mean, even
Right.
during so-called normal times, it's very difficult for economists and strategists and analysts to predict how things are going to go. But right now, it's impossible. And in fact, I think even those enacting the tariffs don't know how exactly they're going to play out as we're seeing them change, minute by minute, it seems. And even if they do know that, they certainly don't know what the consequences will be for the market or for the economy. Because I mean, think about this. We've talked about this before. I wrote about this in my book. Think back to 2020, the year of the pandemic.
Right.
What if at the beginning of the year you somehow had all the front page news about the pandemic, but nothing about the stock market? You would have thought, oh my gosh, sell everything. This is going to be the greatest loss period ever for stocks. And of course, it ended up being an incredible year for stocks. So
Yeah.
even if you have the news, and it's impossible to predict how it's going to impact financial markets.
And I think too that you know, because of that uncertainty, right? And because we just don't know, right, what's going to happen, that's why it's important for us to be diversified, right? Diversification, diversification. I know it sounds boring. I know it doesn't sound, sexy and this and that, but it is vital that we are diversified for that very reason.
Yeah, we're looking at a chart here that is just year-to-date data. This was created yesterday, but is already outdated because of the surge happening as we referenced at the top of the video. But still, the point remains the same. The dark blue at the bottom is the S&P 500, US stock market year to
Right.
date, down substantially. The lighter blue are international stock markets, and then the orange color is a broad bond market. So you can see the great disparity of returns. And if you have a little bit of each, depending on what your overall risk tolerance and time frame is, diversification is going to benefit you over the long term.
Okay. And when we're diversified, right? I know a lot of people right now are trying to time this thing. Well, like, hey, let's move some cash in, or we need to buy at these lows, and we need to do this, and or maybe we need to sell here and then save that cash, and then 3 months later we can buy back in. I'm hearing a lot of investors with these ideas, right? But that's not an easy task either.
Yeah, exactly. And so what we're looking at in the data here is a study from Bank of America that went back to each decade to the
Right.
1930s, all the way through last week. And they said, okay, what were the total returns for price for stocks over that entire period? Just using a round number, let's call it 24,000%, right? Pretty impressive. Well, what happens if you excluded and you missed the 10 best days per decade? Your returns were only 67%. Now, sometimes, Brian, in the past, I've heard these kind of studies like, oh, what if you just somehow miss the
Right.
best days? I was like, oh, that's kind of ridiculous. But what is not shown on this page is they really dug deeper and they found that every single one of those 10 best days came right after significant market declines where people could have easily been scared out of the market and then missed many of these updates. So, yes, this example is extreme in time and in the return difference. But the point being, missing just a handful of those days can be really harmful to your long-term returns.
And I hear from a lot of clients too, like, well, let's wait till things firm up. Let's wait till things settle. Let's
Right.
wait till things are, and then and a lot of times you've missed some of the best returns. Again, if you are sitting on some cash here, obviously prices are down than they were 2, 3 months ago, right? So, you can potentially buy some things, but we would likely say, let's figure out a strategy to dollar cost average this money in and not just try to pick a specific thing. And so, if that's the case, give us a call. We'd be happy to talk to you about that as well. And speaking of declines, right? We are in a short-term decline, but you've got some really good data here saying that it can lead to long-term gains.
Right. And so this was a chart done a few days ago, and it was primarily looking at the big 2-day decline last week, over 10%. And it looked back to the 1980s of, some other significant 2-day declines. And what happened in the future after that? You can see in the 1 to 3 to 6 month period, it was kind of mixed. There's red numbers there, there's green numbers there. It was on average positive, but not decisively so. But as you got out longer term, 1 year, 2 year, it's not shown here, but I'm sure if you went to 5 year,
Right,
substantially higher returns. So yes, the market's surging literally as we speak right now. It could
right.
be down just as much tomorrow. The next few months are likely to be noisy and volatile in both directions. But as you look out longer term, history shows us these kind of volatile periods can be beneficial for stocks eventually.
Yeah, yeah. And again, we're speaking about longer term, right? So a lot of times we get caught up in the noise, we get caught up in the news, what's happening right now, what's happening here. And sometimes I like to ask investors, quick question. There would. Do you think the market will be higher 10 years from now or not? Well, yeah, I think the market's gonna be higher 10 years from now. Okay, well then let's try to take some of this noise off the table then, and let's
Right.
adjust our expectations.
Yeah, exactly. I love this chart. It shows that, over a 1 day time period, the S&P 500 is essentially a coin flip as to whether it will be up or down. If you go out to 1 year, there's only a 26% chance historically that you will have a negative return in the market. If you go out to 10 years, like you just referenced, historically going all the way back to the Great Depression period, there's only a 5% chance that you will lose money over that 10-year period. So that's why we're basically having two charts in a row here. Out of the 10 things you need to focus on, two of them are focusing on long term for a specific reason.
And I would make the case that if your time frame is less than 10 years, stocks may not be, or at least a 100% equity portfolio may not be the right thing for you.
Yeah.
Um, Speaking of 10-year periods, we've been saying this for a while, and I think we're seeing it again, right? That look, what happened over the last 10 years, really 15 years since coming out of the great financial crisis is not going to be like the next 10 to 15 years. So even though to stay invested, like one of the things that we've been doing here at Parallel, we have been using some of this volatility to rebalance and reposition some things because what has worked is likely not going to work as well going forward. Talk to us a little bit about that.
Yeah, I mean, this is definitely something we've been talking about for a couple of years now. People probably get tired of hearing it and say, oh, no, this is a new era.
Yeah,
And maybe in some respects it is. But every era has things that change. And under the surface, there already have been things changing. We pointed out the chart where international is starting to do better.
right.
Value stocks have had a little bit of run of light. I think it's a good chance that inflation is going to settle in higher than it's
Mhm.
been for the last decade. I mean, we can make a list on and on here. It's not so much the specifics that are important
Right.
as it is that people need to try to get this mindset that a more balanced, diversified approach rather than concentrated in certain areas is going to allow for a much smoother portfolio return, which to us is important because when you have volatility in your personal portfolio, that is when you make, back to our second chart, those emotional mistakes.
Right.
And that's what we're trying to avoid.
Yeah. No, good point. All right. We got two more points here to make and then we're done. But I think this is one that is very, very important. And that is to focus on what you can control. Okay. Because what we do a lot of times, and the media certainly helps us, it brings all these things out that we tend to focus on, but we have no control over those things. And we worry and we get anxious and again, emotionally driven, but it's usually about things we can't control. So it's important that during times like this, take a step back and look at what is it that I can control here? What can I be doing that I have impact that can keep me in a good place? Talk about that.
Yeah, I mean, some of these are just the most basics of
Right.
finance and even life. But at times like these, this is when we all need to be reminded of this, right? Everybody's stressed and can't sleep and so forth. But number one, everybody needs to focus on their physical and mental health because if you don't have that, suddenly your financial situation doesn't matter nearly as much anymore, right? You're just focusing on getting better. What are the most basic of finance 101? Having an emergency fund, right?
Yeah.
If the economy was to worsen, it's going to be important for many people to have that kind of fund. And like you said earlier, you know, nobody needs to try to be a hero to pick the bottom of the market or pick the top or what have you. Dollar cost averaging is great during any kind of period, but especially during this period,
Right.
we would highly, highly recommend that. Most of our videos, Brian, are about the market specifically, but of course, here at Parallel, we do a tremendous amount of long-term financial planning. So if we haven't already helped you with that, that would be a huge thing to focus on right now. Definitely let us know. And then, I mean, I know this is probably our most common phrase that we ever say, right, Brian?
Right.
But this is right now is why we always say it, avoid the noise.
The noise.
It's just going to be so important for who knows how long now.
So much noise. So much noise. And just to echo, and this brings us to our 10th point is look, we're managing through this. Okay. I mean, we spend our days, looking at the data, look at these things. We're managing portfolios. We're doing financial planning. We're working through this and we are here and available to talk to you. Okay. We've got an investment process. We focus on high quality assets. We focus on a long-term view. We know that risks have risen, but a lot of times during these increased volatility times, we get great opportunities to invest. So please let us know how we can help you. Give us a call. Here's our contact information. You know where to reach us. We're here to help and answer any questions that you have. Thanks so much for watching and listening today. Have a great rest of your week.